Good morning. Welcome to YX Insights and Happy New Year. Today is January the 2nd, Friday before the market open. The market is going to open in about 30 minutes. So by the time we get to some of the key charts in this video, we're going to have live market data after the open. So we're going to start with the FOMC projections by the Fed Funds futures market. So this gives us a clarity of what the rates market expect the year to be going into 2026. We use the Fed Fund futures to work out the relevant potential cuts for each of the meetings this year. As we can see, the market expects 50 basis points of rate cuts this year. So we're going to finish the year at 3.08, and this is slightly above where the Fed has projected in its December FOMC, but I think it's pretty much in line with where inflation is going to go, assuming the labor market still holds up. However, if we have a further deterioration in the labor market conditions, for example, a big spike in the unemployment rate or large layoffs, which causes a big decline in non-farm payrolls, I do think this front-end yield curve could drop much more sharply, perhaps into the mid 2% or even 2% when we get into the emergency cuts and QE mode. Looking at the bond yields, so we can see that we are expecting some cuts in the first year, and then the curve is actually normal and steepens towards the long end. The 30-year yield is just below 5%, is actually pretty high. So this curve is pretty steep between the 1 year and the 30-year. And the reason being, in the longer end, the market is expressing some pessimism towards two things. First, a more anchored inflation expectation further out the curve. So if we have high inflation expectation, that means the longer term rates are also expected to be higher to combat that. And secondly, the market is still concerned about the supply risk of treasuries. The supply risk being the US government is not being disciplined enough with its budgets and start to issue loads of long-end bonds, and which floods the market, and not enough buyers are going to step in to absorb the supply. What happens? Eventually, the Fed will have to step up and start QE and buying treasury yields to ease the pain. Otherwise, we're going to see a huge liquidity crunch and market crash. In the short term, what drives the market day to day in terms of liquidity in the US is the Treasury General Account balance. So as we saw during the government shutdown, the government hoarded a lot of cash in its bank balance with the Fed. So if you think about this $900 billion, that's just the government shielding the money from spending it because they're not allowed to spend it during the shutdown, and the money cannot make its way into the economy or the markets. And the market generally was flat with corrective moves during this period. However, as this treasury balance starts to decline over time, we get some up days and down days. So up days on the Monday and down days towards the end of the week. But overall, if we get a declining trend in this treasury general account, it means cash is flowing out of the Fed reserves into the bank reserves, and that's supportive for the markets. And the large hoarding of money in the TGA can be seen as being correlated with the SOFR EFFR spread. So SOFR is the secured overnight financing rate where banks lend against each other. A high spread means that the liquidity is generally quite tight. The banks are willing to pay a lot of interest, more than where the Fed has set its target rate, to borrow cash. So what we see is that generally when the TGA is high, this spread actually is quite wide, And because of these sudden spikes, the Fed is quite concerned about the market liquidity conditions, and therefore they're injecting $40 billion of funding in the near end, buying up bills. This was announced in December, and that should be supportive of market liquidity in the short term. What we generally see again towards the month end, so every month end, there is an additional liquidity requirement by the banks to manage their balance sheets and just restrain from lending too much. And we can see that yields spike around this time. So we read on the news that on the 31st of December, there was a additional request of borrowing by the major banks to the Fed, so they can manage their cash positions on the year-end date. So that is actually the correct usage of the standing repo facility, where the Fed can inject liquidity and help banks ease their liquidity pain during month-end or year-end key dates. Previously, the banks were reluctant to use this facility because it was seen as, if other people saw us use it, it means it's a bad signaling. It means we might be much under liquidity pressure. That's not a good sign. But recently, the Fed has encouraged banks to use this facility when they need it. Now, looking at the SP 500 SPY ETF. So if you are a bank analyst, the way you would design your year-end target is to look at where we ended the 2025, look at the PE ratio, and look at the potential earnings growth for this year. SP 500 companies could grow, let's say, something around 12 to 13%. And then you make an assumption about where the PE should land, given where interest rates are, and you would project that into the future. And that's why typically you see bank analysts add something like 10 to 15% towards the year-end target from the previous year closing level. So looking at the Elliott wave technical analysis, I do think we finished the wave 1 and 2 back before Christmas. And while we didn't get a sizable center rally, we did get a new autumn high just before Christmas and on December 26th. So that still suggests to me that investors have a healthy risk appetite for equities and risk access generally. And we should be on track to breaking 700 imminently. I do think going into mid-February, we could tap the wave 3 target around the 720 level, or at least around 700 plus. And seasonally, we get a week mid-February onwards, a potential follow through in March. Just remember 2025, we saw the market top locally in mid-February, and then it had a nosedive in March and beginning of April. So that seasonality and seasonal weakness is something we should watch out for. So I do think January we could be volatile, but generally we should be trending upwards towards the 700 plus target, and then get a bit more cautious towards mid-February onwards. QQQ, interestingly, QQQ didn't break the autumn high, but I still think this was 1-2 completion, and now we're headed towards the wave 3 target, potentially around 675, towards even 700. And there is a healthy volume building here as support. So if we fall back, I think there will be a lot of dip bias, at least in the 600 region where we stopped in the previous decline. So going in towards 670 to 700 is my primary expectation towards January and early February. IWM, Russell 2000. This is a corrective move. We are now in the wave C leg of this wave 2. And that brings us to a target of 240 to 243. This is a very supportive region where we have the 50-day moving average as the first support and a ton of volume as support here. So once we get to 240, I'll be surprised not to see a lot of dip buying and supportive price action over here. So I think that is probably a dip buying opportunity once we approach 240, and we can start thinking about wave 3 afterwards. And wave 3 can easily challenge 280 as long as my thesis over here stands. Generally speaking, lower yields with Fed rate cuts is supportive of small caps and long duration in risk assets, meaning that if you are a company that doesn't yield free cash flows yet, and most of your net present value of the free cash flow is backloaded into a terminal value that is derived from cash flows 10 years out, a lower interest rate will help the discount factor of that terminal value to increase your net present value of the cash flows. So that could be supportive of the valuation of the small cap stocks. Looking at the 30-year yield, I think this was an ABC corrective move of a larger degree wave 2, and it has almost reached our wave C target. We've set this target a while back of 4.9. So I think we could still tap this region, but I think the risk reward of chasing yields higher is not really there. PLT has not yet tapped the 200-day moving average. I suspect it could, just to finish off this wave C. And that would complete our 1-2 setup for a large degree wave 3. I think from here, wave 3 could challenge the 100 level. Our machine learning signal has also turned to a buying status for TLT. So I think in terms of the target and also our machine learning signal, we are probably in a buyable region over here. So I do think 200-day moving average is likely to support if we get a further drop. As my primary thesis is that bonds will move higher in the long term. US oil, our machine learning signals have been risk off for a long time, and that has played well with the overall downtrend of this market. So what I do think is that we should be looking at the low 60s to complete this wave C here. And that will be the lower end of this medium-term channel that started in 2023. Once we complete this in 2026, we could be looking at maybe a breakout higher afterwards. But for at least the first half of this year, I still think oil should trend down, and that will help yields coming down as well, as the inflation expectation is heavily driven by oil price outlook. Bitcoin, we haven't had the risk on signal yet, so the price action has just been moving sideways for a while, now challenging the 50-day moving average. But this chart here now does remind me of when we start having a breakout in April 2025, where we moved above this trend line and then also above the 50-day moving average at the same time. So that was the beginning of last year's breakout and the rally towards 125. This does look quite similar to that, even though we didn't get a lower low in the near term. So if that is the case, I'm looking at a 5-wave up pattern, first to challenge the 200-day moving average in this wave 3 with heavy supply region over here around 110K. And then we could finish the initial 5 waves off in the 115 to 120 level, but shy of this all-time high. So a lot of work to do. We're in very early stage. If we do get one more low, i.e. my bullish thesis is wrong, I do think Bitcoin shouldn't move substantially below this box here. So I do think here we'll have the ultimate low pinned. Do I think the 4-year cycle is still in play? I think that theory is getting outdated, even though it still holds a huge psychological weight on the investors. So this October 7th top was exactly where you would have the top if in a 4-year cycle. And I think that did play a role psychologically to mark the beginning of this downtrend. But in terms of the overall debt cycle, as well as if you're looking at copper to gold ratio and ISM business cycles, there should be one more high for 2026 before the top. And that could be the ultimate blow off top that we never quite got back in 2025. Looking at Ether, so it has been coiling pretty tightly into this triangle here. We need to get above this medium-term trend line. We've moved above the 50-day moving average, which is pretty encouraging, but we need to jump over, and then we can start thinking about the next wave 3. So if this was a 1-2 setup, we could be looking at after the breakout a 1-2 wave 3 towards 4,000, and then wave 4 retrace, followed by a challenge towards the autumn high around 4,600. So it is looking quite promising that this might be the pattern that will play out rather than a lower low. But in case I am wrong, which of course anyone could be, this red box here highlights my expectation of where the lower low would terminate. So if we get a lower low and this expectation is wrong, I don't think we'll drop substantially below the price level of 2,200. Solana, we are not really seeing a breakout yet as well. And our machine learning signal has been risk off. So we're getting above this trend line first, which is good. We need to challenge the 50-day moving average, which Ether has done. And we then need to start looking at the wave 1-2 setup afterwards. So we're very, very early. This potentially is the bottom, but there's no clarity around this just yet. So I would just wait and watch and not get too far down the risk curve in terms of altcoins. Ripple, interestingly, Ripple has seen intermittent risk-on signals from our machine learning models. It is a very volatile asset, more volatile than Bitcoin and Ether. And if this was the wave ABC flat of this wave 4, I would expect wave 5 to challenge the 5 level, so more than double today's price. But again, we're in a very initial stage of the recovery. There's no sure sign that we have definitively bottomed here yet. So I really want to see a breakout towards this 200-day moving average at least to confirm. So Coinbase has made a new low, which means this wave C is unfinished, and we are potentially in a 5-wave down pattern here. This wave 5 could really land anywhere between 200 to 220 here. So there could be one more low to go. The path of least resistance is definitely here. And Coinbase does largely follow Bitcoin and Ether in the big picture. So it tends to overshoot the rises and then undershoot the declines. But on the day-to-day level, the correlation is not perfect. It's not 100%. And even if they're moving in the same direction, it doesn't mean the magnitudes are the same. So I would prefer just watching each chart as its own and just see how because ultimately Coinbase represents how the equity holders are playing the crypto market, whereas Bitcoin and Ether are much purer bets. And in the near term, there has been a lot of pessimism around Coinbase's competitiveness versus Robinhood. However, I do think we are at a similar place to Robinhood at the beginning of last year, where we touched the IPO high and retraced, and then we had a massive run up afterwards. I can easily see Coinbase doing the same thing after the short-term correction. So I'm pretty optimistic that this is not the high we will ever see, and we should get at least one more high in this wave 5 subsequently. Robinhood, previously I did think there was a chance this is a wave 5 top, but looking at the broader market, I do think this is probably more likely a wave 3 top with a wave 4 correction that is ongoing. And if we hold this low, this could be a wave 1 to set up for this wave 5. Our machine learning model has just switched to risk on today for Robinhood. So I think the model is picking up some bottoming signals from the past price action and the macro environment. So we could potentially see a rotation from commodities as well into the crypto side as the crypto related assets start bottoming. So that is one advantage of having machine learning models for both crypto and commodities in our service. I think we're still quite early in this process, if that is true. So I'll be quite eager to see how this plays out. So for now, I do think this potentially is wave 3 top, wave 4 pullback, ABC correction. This is pretty textbook, and I'm looking to see if we can get started on wave 5. Strategy has seen a horrendous multiple compression. So its MNAV has moved from 2 plus to now 1.1, 1.2 level. So it's not really trading at a meaningful multiple anymore. And that has driven a huge underperformance of strategy compared with Bitcoin itself. Now, this correction does look more or less complete in terms of depth. So we have wave A from here, and then from wave B high, we got the 1.23 extension at where we're trading now, so 150 level. I'm quite interested to see how it makes its way back up to at least above this volume profile here, to give us some encouragement of the beginning of the larger degree wave 5. But if the rest of the crypto market starts to rally, I think that risk sentiment will return for strategy, and everything will be once again aligned. In a bear market, a lot of correlations and relationships do start getting detached. That's why a lot of old observations and rule of thumbs don't work when things are just falling apart. But now, as we are moving towards a constructive process of recovery in the crypto world, we could see the relationships of positive correlations start moving together once again for crypto, DATs, and exchanges. BMNR trades at a positive premium to its Ether holding at about 1.2x. In comparison, SBET SharpLink trades at 0.8, which is a discount. But BMNR has a larger market capitalization, is more, it enjoys bigger volume, bigger options market, and it has managed to hold this low from November. And this could potentially be a wave 1 to set up, and that could give us a target in wave 3 around high 60s to even low 70s. Again, in this wave 3, I do think we'll see a lot of obstacle challenging the 50-day moving average. And then into this high volume region of 50. So we're still very early in this process. So we need a bit more patience. SharpLink, the price action is not as favorable as BMNR. It has a slightly smaller volatility. It's less popular of a ticker. It has a smaller market capitalization. And recently, it didn't manage to hold this November low. But I do think this wave 5 of C could terminate around between 7 and 8, which to me suggests is a very good buying opportunity. And of course, if we get a breakout in Ether straight away, then we don't even need to challenge this low region here. Gold, we had a sharp drop last week, along with other commodities post Boxing Day. And we're now around this wave 3 high. So this is a supportive region now. This potentially could finish this wave 4. And if that is the wave 4 bottom, we're looking at wave 5 around the 430 to even 440 level. Gold miners. So if we're looking at this pullback, we've tapped below the 0.23 retrace of this wave 3. And of course, we can go deeper into the 0.38 extension for wave 4. But if we hold here, we're looking at a potential wave 5 just below 100 level here. Now looking at silver. Silver likes to do those very sharp rallies. So for example, 170% in just a few months, 150% in 2020 after COVID. And more recently, we've gone from 25 to 70 in a matter of months as well. This looks like a very sharp parabolic rally. And that could be the end of wave 5 of this large degree wave 3. So what I mean is that in the short term, I think chasing silver, the risk reward is not really quite there. And we are tapping the 1.61 extension of this wave 1 from the wave 2 low. If we get a pullback, and if we're looking at all of this wave 3, wave 4 could retrace into the 50 region for a fairly shallow retrace compared to this wave 2. And then we can look at one more high in this wave 5. Silver miners, it has tapped the 1.38 inverse extension of this wave 4, but theoretically there's room to try the mid to high 90s to complete this wave 5. But to me, the risk reward isn't quite there for chasing this trade in the short term. So I'll be more monitoring. If I didn't have a position, I'll be waiting to see how this chart pattern develops. If there's a bigger pullback, a machine learning signal is off today, risk off today. So I'm also going to follow that for how it assesses the macro risk as well as the price technicals on silver miner. Let's say if we did top here already in this wave 5, then wave 4 theoretically could test the low 60s region for a pullback. I think the 200-day moving average will travel up as we go along. It could potentially even test that before finishing the wave 4 correction. So very early stages, not a definitive chart pattern for confirming the top yet. We just see how it moves from here for the next buyable dip. Palladium made a sharp retrace after Christmas, and we have tested the 0.236 retrace of this wave 3. So that is the shallow end of the wave 4 pullback target. It could move as far as 130, which is the 0.38 extension, testing this 50-day moving average first. And so far, the 50-day moving average has been more or less a support for this uptrend. So I will be on the sidelines watching how the chart plays out before making a dip buy. Platinum, again, a very parabolic run since November, and we could be finishing off 5 waves of this wave 3 in terms of extension. So this wave 5 is pretty extended. And now if we get a pullback, we're looking at minimally 176 for this 0.236 retrace of this wave 3, but more ideally the 50-day moving average around the 150 region for a healthy pullback and the dip buying opportunity. That will be wave 4, and then we're aiming for one more wave higher in wave 5. Copper is a very volatile instrument, as you can see here. So charting this isn't quite easy, but I have tried my best. I do think we have one more wave higher in this wave 3. And this is wave 1, 2, and then 3, 4 that ended recently in August. And potentially we get 5 waves here in this final wave 5. So I think short term, there's still some gas in the tank for copper to move higher. And copper tends to outperform during positive business cycles when ISM starts moving higher as well. So my near-term outlook is fairly positive. One interesting observation. So we mentioned this gold versus platinum ratio last time, and this actually looks like an ABC corrective pattern where gold got very expensive against platinum in Q1 of 2025. And since then, we are seeing a declining trend where platinum starts to catch up with gold. However, this wave C didn't quite reach the 100% extension of this wave A. There is more room for platinum to outperform, meaning this ratio goes lower, but the most of this move is already done. Apple, not a lot has changed since my last update. We managed to hold this low in this wave 4. So I'm looking at a positive run here towards 300 to finish our wave 5. And typically before the Q1 results, I do think market could give it one more push on high hopes of very positive Q4 iPhone sales. And I would expect the Q1 earnings to be a sell the news opportunity when it comes. Amazon, I haven't touched this chart since our last update. This wave 2 low did manage to hold, which is very nice. So now we could be looking at the wave 3 target around 270 in the short term, and on a larger degree, we're looking to fill out this wave 5 here towards 300. And I do think all of this was accumulation for a sharper move higher next. Google, a phenomenal stock, massively outperformed the S&P last year. I do think now it's getting quite stretched in terms of how far this run was. And this could potentially be a wave B of this wave 4. I would ideally want to see, or at least wait for, a wave C correction towards 270. That would give me a nice re-entry level for this wave 5. Meta, our machine learning signal has been risk off for a while, and we managed to dodge this big drawdown here. So that's nice, but at the moment, I'm not entirely convinced that we've bottomed. I think even if we did bottom, and we're looking for 1-2 setup, we should get one more retrace here. And of course, the risk of this being a 5 wave down is still there. So I am still in the sidelines mode, waiting for Meta to show its hand essentially before I make the next move. Microsoft has managed to stand above the 200-day moving average in December. And we are looking for this new wave 1 into 508, this high volume profile region, and then followed by a retrace in wave 2 that will kickstart the entire 5 waves of this wave 5. Where at the very beginning of that stage, Microsoft has been pretty slow in gathering this pace of recovery. So I think more patience is needed. NVIDIA, I re-examined the chart. So previously, I think there was a high risk of this being wave 5 top, but looking at the broader market and looking at the semiconductor stocks, I am more leaning towards this being a wave 3 and this is wave 4, and in terms of the shape of this pullback as well. So we haven't got conclusive evidence that we've bottomed here, but at least we're above the 50-day moving average and its volume profile, so that's constructive. And if this is a wave 5, one more high, we could see 260 as the potential target, and that will play quite nicely into the 176 extension of this wave 4. Tesla. So I think we are in the end game for this wave A, and we're looking at wave 5 of this wave C of this wave A. And what this could be is a 1-2 back in November, and then wave 3 before Christmas. And recently, analysts have revised down the target for Q4 deliveries. We've seen a decline in the stock price again towards the 50-day moving average, although it has seemed to stabilize around this region. This looks like a wave 4 pullback, and I would expect perhaps by the news event for this wave 5 higher this month. And I think things will get trickier after the first earnings. If we get to the mid-50s region for this wave 5, I think it's a good opportunity to take profit in case of a cyclical drop in this wave B. So Tesla does this a lot. It runs up violently, gets everyone's hopes up, and then it declines rapidly afterwards. And everyone becomes really pessimistic, and then does this run up again to recover to a new autumn high. So it's a very volatile stock, and I would not try to be perma bullish or perma bearish about the stock itself, and instead just look for technical patterns of how the stock could behave. So Palantir, I think it's difficult to short this stock. I think even someone like Michael Barry, he might be ultimately right, but even he knows not to short the stock outright, and instead he has put options that expires in 2 years, and that would probably give him enough time to prove his thesis correct. So in the short term, of course, this thing could move anywhere. Previously, I do think this was 1, 2, 3, 4, wave 5, and that could be the wave 5 top. But thinking about the broader market, this may have just been a wave 3, and we have one more wave higher. So for now, I don't want to preempt too much. I want to see how it unfolds in this current correction below this volume profile, as we broke down the 50-day moving average. The shape of this correction will give us more clue on whether we could get one more high, especially if we manage to defend the 160 area and the 200-day moving average. AppLovin is one of the best stocks of 2023 to 2025. Back in 2023, it was only $10, and we're looking at a 64x since then. So that is pretty amazing. So right now, I do think this was wave 3 and wave 4 pullback, which means there is a bit more room for this wave 5 to play out. And that could challenge the 1,000 mark even, which is just simply incredible given where the stock was just a couple of years ago. On the smaller degree, this could be a 1, 2, 3 here, and that is a corrective move. And we're looking at one more high here. Oracle. So there is a lot of concern about the Oracle's debt issue. So that's driven the price of CDS, which is credit default swaps, up. So credit default swaps is like insurance on the company's debt that anyone can buy against. The higher the price, the higher the risk of the perceived risk of the company's default by the investors. So if we look at this drawdown, this is a 5-wave pattern. So that really shows how severe the issue is, and we're potentially getting a death cross on the 50 crossing below the 200. So now this wave 5 does look potentially complete in terms of the depth, and we can potentially look at the next waves up. But that could be a B wave, and that's quite difficult to trade. So for now, let's just wait and see how the chart unfolds in the next few weeks. On the more constructive side, generally speaking, I wouldn't like to trade the B wave because there's no guarantee how far it could go. CrowdStrike. So the infamous CrowdStrike outage event, code bug that affected millions of computers worldwide, essentially put in a wave 2 correction for crowd that coincided with carry trade unwind. And since then, we've had what I believe is a 1-2 setup into the tariff day event in April 2025. And then after that, we've got potentially another 1-2 setup from there. Overall, I'm pretty bullish in terms of this chart for crowd. We haven't seen anything near a parabolic rally, whereas we get a few 3 steps forward and maybe 2 steps back, another 3 steps forward and 2 steps back, and more of a steady rise for crowd. So this wave 2, if this is wave 2 of this larger degree, wave 3, could test the 430 level for a deeper retrace, but there will be a lot of support around 430. So I do think this is a fairly nice dip buying opportunity, just looking at the chart technicals. And then wave 3 could test the 700 level. I would probably ignore this timeline. I'm just trying to fit all the levels into this chart. Of course, for the stock to get from 450 to 700, it will take much longer than where this chart is showing. Cloudflare. So Cloudflare, after the bear market of 2022, I think we completed the initial primary wave 1 in the leading diagonal pattern here, very steadily with very well-defined tops and bottoms in a well-defined price channel. And now we are in a larger degree primary or wave 3. But within that wave 3, we complete the initial 5 waves up in 2025. And my concern is that we are now in a corrective pattern of ABC correction before the next wave higher. So in the near term, I think we could get a bounce towards the low 200s, but that could be a wave B. So I'm just a bit cautious right now. If I am wrong, the chart will show that by taking our new high, and we could be thinking about the larger degree wave 3 after this wave 1 here. SOXX, that is the semiconductor ETF. It moves more or less in line with SPY, surprisingly more than stocks like NVDA, and it has made a new high in the past month, and this target could be even higher than where we are, because this could potentially wave 1-2, and then if we're looking at that as an extension, we could even get something like near 400 for all 5 waves of this wave 5. Broadcom, we topped in these 5 waves of wave 3. So I'm now looking for a corrective pattern to play out for this wave 4 here in the short term. So in the near term, we could rally with the broader market for wave B into mid-February. That will be a wave ABC pattern. And then with seasonal weakness, we could see a large degree wave C testing the 200-day moving average. I'm a bit cautious here. The speed of rise has definitely slowed recently, and we're seeing high highs and high lows. So the market is actually in a very uncertain territory in terms of how to value this stock. This is very typical when the market isn't quite sure about whether we're in the AI bubble or the legs of this bull market. ASML. ASML long-term chart is pretty encouraging. I think we put in a wave 1 and 2 by beginning of 2025, and now we're likely in a wave 3 territory here. And this is confirmed by taking out a new high more recently. So this is definitely a very long-term chart into 2030. But I think even though we've had a rapid rise in the past few years, there is still a long way to go in this cycle here. ARM holding has basically traded in a wide sideways range since 2024. So the lows around 80 and the highs around 180. So that's a pretty big range. Recently, it couldn't quite break above this trend line at the top. So we've got a wave 2 lower. And I do think, so where I've highlighted is the typical termination zone for the wave 2, so around the 0.618 to 0.78 retrace of this wave 1. If we manage to hold, we can be thinking, even assume the worst case scenario for this wave 2, we can be thinking of the wave 3 around the mid to high 300 region next. So we want to see the stock hold here with the ABC pattern and then break out above this top to really confirm that we've started wave 3. AMD has been a more bullish chart than NVDA in the more recent month. There is some rotation and catch-up play going on. And if this is a wave 1, 2, then wave 3 could challenge the high 400 level next. So that's it for this week. Thank you for joining me. Let's speak next week.